Good afternoon, and thank you for joining us today. My name is Bobby Lord. I am the Assistant Vice President for Investments at Foundation for the Carolinas. On behalf of the executive leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the chat window. The Mercer team will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded and the link will be added to the fftc.org website. And I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the fourth quarter of 2024.
Great. Thanks, Bobby. And thanks, everyone, for joining us today. Getting my slow computer to work. My apologies. So on the agenda today, as Bobby indicated, we'll do a quick market overview, basically the fourth quarter of the finished 2024. And then we thought as a special topic for this quarter, we actually would do a full year in review. So we're going to go through some in deeper detail around market activity in 2024. We'll also close with some thoughts around what we think is on the horizon for risks and opportunities for client portfolios and investment portfolios around FFTC. And then we'll talk about the standard pool performance, as Bobby noted. And then as Bobby noted, of course, we'll take all the questions you can throw us. So we look forward to hopefully an interactive session, and let's jump right in. So starting as we often do, just a quick recap of the quarter. We did see equity markets finish down globally about 1% in the quarter. Lots of things going on, which I will talk about as we go. But at the top line, global equities, including U.S., non-U.S., and non-U.S. or emerging markets, were down for the quarter. But once again, led by U.S. stocks and, frankly, still leadership amongst the biggest, growthiest names at the top of the benchmark. The Magnificent Seven, which we'll dive a little bit deeper into again this quarter, just continued to generate returns through the end of the year that led the way. And so that has allowed U.S. markets, even with weakness in sectors like U.S. value over the course of the quarter, to continue to lead the way. Non-U.S. markets, you can see all down around 8% for the quarter. A decent amount of that was as a result of actually dollar strength in reaction to both the interest rate environment in the U.S. as well as the resolution of the U.S. presidential election and down ticket elections. And so we did see the dollar rally over the course of the fourth quarter, and that helped contribute to also modest negative returns in the local markets outside the U.S. As we'll talk about a fair amount today, we will see that interest rates backed up pretty significantly over the course of the quarters. We saw the yield curve steepen in response to a number of stimulus, and as a result, U.S. aggregator, our broad fixed income measure for the fourth quarter, was down about 3%. And that boiled over into more interest rate sensitive sectors of the marketplace like REITs, which were down about 8%. So not a great quarter overall, unless you happen to only own U.S. growth stocks. But for the full calendar year, it was another really pretty solid year. We saw global equities up about 17.5%, again, led by those biggest, most prominent U.S. growth names, up over 30% for the calendar year, making small cap and value performance, which, double digit years are nothing to sneeze at, but making them feel rather paltry, and just another stacked on year in terms of outperformance from those parts of the market. You can see non-U.S. markets, again, influenced in part by that fourth quarter number, not generating as buoyant returns, but at least positive. And then we did see, even though rates did back up, we did see the aggregate pull together a small, modest, positive year for 2024. So all in all, pretty good market environment. And we thought we would dig a little bit deeper into some of the things that drove that, as well as, like I said, give you a sense of where we think the world's going. So what you're looking at here is over the course of the calendar year, cumulative performance for global
Hey,
equities,
Travis.
which is the blue. Yeah,
Travis, I'm not seeing your screen. I don't know if the participants can, but it is not up on. I'm just seeing you and Bobby.
Bobby, can you see my screen?
Yeah, I'm seeing that from my end.
Okay. Okay. Sorry for the interruption
Thanks,
then.
Tim. No worries. Thanks, Tim. Hopefully everyone else can see it. The blue line is the cumulative return for global stocks over the course of 2024. The green line is the cumulative return for U.S. aggregate bonds over 2024. And then overlaid on top of that with the pink line is the yield on the 10-year Treasury over the course of the year. And so I'll walk through just briefly some of the key events and so you can see how they've impacted results over the course of the year as we move through the year. So we started 2024 with continued positive momentum from the AI story and from the mega cap stock names. And so you can see pretty good solid growth of return in the first quarter of the year. We did see, as a result of that, yields on the 10-year start to move higher over the course of the year. There's pretty good confidence in the general growth level as well as in this AI story. The market's been very reactive and very responsive, if you will, to changes in stimulus over short periods of time. So as GDP growth came out lower than expected and inflation finished above expectations for the first quarter, we did see yields rates spike right here. And we saw equities sell off some in the end of the quarter. But, again, each new news item brings a new day for investors. We saw equity markets basically recover their trend. 10-year Treasury start to come down as well. The economic data perhaps was good. It wasn't great. And as a result, investors could start to realign again and think about the possibility that the Fed would cut rates and that we would see coordinated rate cutting efforts around the world. We were hit with a series of political and technical events across the course of the summer. Of course, the assassination attempt against Donald Trump and the change in the Democratic nominee caused some turmoil. There was some technical trading issues around the yen, as there's been a lot of noise in the yen and in Japanese financial markets this year. And then China came out late in the summer with some meaningful stimulus. And so, as market turmoil went up, we saw a little bit of flight to quality into Treasury. So you can see the 10-year Treasury yield coming down pretty significantly. And again, market participants betting pretty heavily that the Fed would cut rates beginning near the end of the year. And then that would lead to a continual slope lower and continual activity from the Fed to drive the overall interest rate lower. Fed cut rates 50 basis points the third week in September, and actually we got an action a little bit different than that, with yield markets over the course of the next few months. With the Fed 50 basis point rate cut, they also had less definitive language about the speed, direction, pace of cuts looking forward. And at that time, in our view, the market started to actually price in what might be a much more normal outlook for interest rates. And we saw this yield curve steepen. And in fact, before the end of the year, the yield curve, which had been inverted for most of the calendar year, actually moved positive over just about every tenor of spread between, say, 3-month treasuries, the 2-year, the 5-year, the 10-year. We saw all of those spreads actually move back into positive range and a much more upward sloping yield curve. With the resolution of the presidential election, coupled with some more rate cut activity in the fourth quarter, we saw a continuation of the rally in equities. That had been more or less unabated for most of the year. We did see yields drop, a bit going into that fourth quarter period as investors started to realign. But after the second 25 basis point cut, the cycle view was once again reinforced by the Fed that there was going to be data dependency, a fair amount of discussion around each potential rate cut. And that once again changed investors' views. And we saw rates tick back up to the end of the quarter. And we saw the stock sell off to create that fourth quarter modestly negative return overall. So fair amount of activity in the year. on a broad picture, pretty volatile at times. And, I think once again, reinforcing the market's reactiveness to data points and forward-looking views. So if we take a bit more granular view of that, then if we look at U.S. stocks, on the left-hand side of the chart are U.S. stock monthly returns done in a waterfall chart to give you a sense of how they stack together to generate a nearly 24% return for the broad U.S. stock market over the course of 2024. And you can see with limited pause, a pretty good year for U.S. equities. That was against the backdrop where bonds, as we saw in that 10-year, in that waggle in the 10-year yield pink line on the previous page, some pretty meaningful drawdowns for the bond market over short periods of time. And interestingly, the returns of the stock and the bond market were pretty well correlated to points in time when investors were either forced to or most notably realigned their views on the direction and pace of interest rate cuts. So early in April, and then again late, in the fourth quarter, we saw pretty big shifts in interest rate positioning, and that coincided with some rougher periods for markets. So we did see some coincident action amongst our sort of two big categories of things we can invest in that contributed perhaps to a little bit more overall volatility for those short periods of time across portfolios in general. That being said, equity markets, just U.S. equity markets particularly, have continue to be a juggernaut. And absent really the pretty challenging 2022 period, the returns out of U.S. equities have been pretty phenomenal. And this is the total U.S. stock market, so this includes small caps as well. But for the last decade or so, 2 negative years out of all those years, and an average return in double digits. In fact, absent 2015, every period return over that period has been double digits. And we're going to talk about some of the reasons why that is, or why we think that there's been some contribution to that. But the U.S. market has really been on a tear, while rates have struggled, particularly more recently, to move off of the zero interest rate environment. We maybe don't recall that in 2020 the 10-year Treasury actually was sub 1% in yield, whereas today, I didn't look at it today, but let's call it in the 450s or somewhere in the mid fours, and that's really where we get these 2 years of performance. But the bond market's been trying to really has struggled some and continue to struggle over the course of this year to figure out where rates are going and where they should be positioned in terms of both balancing return potential as well as risk. I want to look at one other thing on this as well. Just looking at leadership, as we think about, we do believe in diversified portfolios. We do want to own things outside of just U.S. large cap, regardless of how strong they have been for some time. But just reinforcing that it has been a pretty narrow leadership over 8 of the last 12 calendar years. The S&P 500 does outpace U.S. small cap stocks and non-U.S. stocks in 8 of those years. And in some years, and in fact, most recently, more, I guess, domination, if you want to use the word, the spread has widened between returns in the U.S. and non-U.S. securities. We don't think that goes on forever, but there are some factors that continue to contribute to that, and that we'll talk about more as we talk about where we're going, where we think we're going in the future. As we get closer to the finishing off, 2024, there are I mentioned a couple of these already, but I think some pictures can tell some stronger or leave a more lasting impression. Top 2 lines are the top line, the greenish blue line is the S&P 500 cumulative return for 2024. You can see up about 25%. The S&P 500 less the Magnificent Seven stocks, so the returns basically for the other 493 companies, up only about 15.8%. So, almost 1,000 basis points, or almost 10 full percentage points of additional return generated as a result of those 7 companies. That is, if not unprecedented, certainly historically a pretty high level. And there's a fair amount of good news discounted into those names. I'll talk more about that in a minute, but certainly the haves and the have-nots, or the haves and the have-lesses, I guess, because again, 15 is not much to sneeze at in terms of return. pretty pronounced. And if we drew this line, and I think we do here in a minute, back a couple of years, it would be as equally pronounced, if not more so. The other notion I mentioned is that particularly late in the year, see this portion of the low blue line here, or these two lines here, is basically the fourth quarter of the year. The blue line is the EFA, so developed markets outside the U.S., unhedged, so just taking the currency risk, which is how we invest. When you compare that to the hedged version, or hedging out the impact of the currencies, you can see about 7 percentage points of return differential for the calendar year. And again, virtually all of that coming, well, there had been some recovery mid-year and then giving it all back in terms of the strength of currencies, foreign currencies against the US dollar. We did see the dollar surge, as I mentioned, in the fourth quarter, and that really did create some spread in performance. Those things happen periodically, and we invest in an unhedged basis because we think we believe that currency variation is part of the diversification story. In this particular time, it worked against the U.S. investor, and other times in history, and we think certainly other times looking forward, that currency differential will work in favor of U.S. investors. But certainly in the short term, definitely a headwind to overall absolute performance. On those Mag 7s, this with due deference to our friends at JP Morgan, who create some pretty great charts. This one was so good we wanted to borrow it, and I'll really just draw your attention to the right-hand side of the chart. That leadership of the Mag 7 names, as I said, is not without reason. What you're looking at the top are earnings growth or earnings per share, or in green the Mag 7 companies, and in blue, basically the other 493 companies in the S&P 500. And anything prior to fourth quarter of 24 are actual results, and anything ahead of fourth quarter of 24 are estimates, street estimates for earnings per share growth. And you can see, just by virtue of the chart itself, you can see the magnitude of corporate outperformance for the Mag 7 versus the S&P 500, both on earnings, which is the top chart, and on profit margins. Mag 7 are large, profitable businesses that have been able to grow profitably. And in fact, at levels well above the rest of the stock market. And in many ways, it makes the returns, or at least some level of the returns of the Mag 7 rational. Investors will pay a premium for large and what feels like consistent growth, and indeed they are. And they have been those investors that have loaded up on those, or that have invested in those, including the foundation portfolios, where we have a fair amount of exposure through our large cap allocations. We've been rewarded, and been rewarded with good corporate performance that has translated into really pretty phenomenal stock prices. And as you can see, these are the 2-year cumulative returns for the Mag 7. So back to the beginning of 2023, and you can see that they're breathtaking in the notion of, say, NVIDIA, that's up 8 times over a 24-month period, to just really pretty good at up 78% for Microsoft over the same period. And what this suggests to us is that the market has reinforced those numbers I showed you on the previous page. There's been strong earnings growth. These have been solid companies in terms of generating economic return for their investors. There is a decent amount of good news discounted into these return figures. And so if those previous page earnings start to come off, or changes in the competitive environment come to light, most notably the DeepSeek release. Those of you that are not familiar, DeepSeek is a Chinese AI company that came out and suggested they could deliver on the inference portion of the AI universe at a much lower cost and at a much faster pace than perhaps is implied by the big spending done by companies like Microsoft and Alphabet and Meta in support of companies like NVIDIA, where billions and billions of dollars of capital expenditures have been made to do faster, greater AI. DeepSeek, with some questions still about the overall validity of the data, but be that as it may, it did put a shot across the bow for investors and for these companies that we have to be mindful of competitive environments and competitive exposures of these companies, and then the related stock prices and what's priced in. So, these companies are, they carry higher valuations, albeit I would argue not valuations at the same level generally as we saw, say, back in the TMT bubble, but still higher than average for the overall market. And so there is some good news in here. And so that's, those changes to those competitive markets could have some, could be a risk factor on the horizon, as we just think about the baskets of things to worry about. Last thing I'll touch on for the 2024 review is that while returns have been really strong, they've basically been strong in one direction. So what you're looking at here are average, the percentage change per day evaluated over the course of a calendar year. So as example, the dark green section of each bar represents the number of trading days in that respective calendar year where there was a greater than 3% move in one day, or the very darkest red is just the inverse of that, the number of trading days when there was a more than 3% down day, and then the variations in between those in terms of numbers of days. Or I guess that would, yeah. So what you can see is after some pretty volatile years, a couple of years in 2020 and in 2022, where there was a fair amount of days where there's a lot of big movements, the last couple of years have really settled back down to what we saw through most of the teams. But you can see over time that there is the possibility, in fact, earlier, this represents the earliest, some of the earlier parts of my career, and we did see a fair amount of increase in volatility in the late 1990s. Again, around the global financial crisis, the COVID and the interest rate environment crisis here more recently, and then it settled back down. So I think that's another thing for us to just keep in mind as we look forward, that they can be up and down activities, right? These back here, if you think about the late 1990s, a lot of trading days with a lot of big moves, but by and large, those were really strong return periods, followed by equally volatile and also generally down return periods. So I thought that was another interesting thing for us to think about as we move forward. All right. So what's on the horizon? And these are not very exciting charts, so I'm going to try and move them there rather quickly. So what's on the horizon? So impacted from changes proposed or enacted by the new administration. There has been no shortage of announcements coming out of Washington for the last several weeks, and not all of them, what's the word? It's not been a linear progression of ideas put forth by the new administration, which has caused some confusion and has caused lots of discussion and some market reactions. So the notion of tariffs, this has been, this was a big part of the campaign. It has been a big part of conversations for the last 2 weeks. Our take is that it is largely unsettled. Clearly, whether we end up with more permanent tariffs and to what extent is unclear, but it's definitely a bargaining tool for this administration to use. And because tariffs very likely create economic impacts in some way, each time they're raised or each time they're put forward, it creates uncertainty in the marketplace. That's a risk I just think we need to be aware of. The possibility of tax cuts, there's a narrow majority of Republican control in both houses of Congress. That being said, there are a decent number of deficit hawks in the Republican caucus. And so I think tax cuts, while generally believed to be on the horizon, the level and magnitude of those still remain to be seen. And to the best, I have not, I might be a little behind in my reading, but nothing in the near term agenda on Capitol Hill in terms of pushing forward the tax cuts as they see them. We are seeing a lot of conversation about governmental spending reductions, and regardless of how one might see the activities, the reality is we're running a $1.8 trillion federal budget deficit, and in many ways, perhaps that's not sustainable, though. So U.S. government is tasked with trying to find ways to get closer to a balanced budget. It has been a very long time since we've seen a balanced budget, but $1.8 trillion annual deficit is about 6% of U.S. GDP. And so we should also be mindful that while that is perhaps a need or a admirable task for the U.S. government to undertake, the reality is if you cut if you somehow are successful to cut 6% of GDP from government spending, that does not mean it's going to get made up somewhere else, and that's probably going to that will probably lead to some kind of slowdown in economic activity. Probably. The crystal ball is not perfectly clear there, but I think, again, something just to be mindful of. And then, there's some other noted ideas. Sometimes not clear just how serious, but, the acquisition of Greenland, the acquisition of Gaza, it's unclear whether those things will come to pass, but we should just realize that those things are not free. So to the extent that those positions are pursued, again, that's another, if you will, again, back to my notion of nonlinear policy discussions from the administration that just add to confusion a bit in the short term. In the meantime, we got inflation updates this week. We've been operating under the view that we'll see some stabilization of inflation and we'll start to move back towards the 2% Fed target, but certainly yesterday's inflation numbers belied that a bit, where short-term inflation rates through January were 3%. And so that 3% environment suggests that we could be looking at structurally higher rates over the intermediate term horizon. And that is a different story than we've seen from bond markets over the last 2 years. And every once in a while, we get a little bit of a run that bond market participants believe rates are going to come down, and then that unravels or unwinds as we get new prints on some of these data. So I think the story around interest rates is likely to be structurally higher over the intermediate horizon. And again, it will be impacted by some of these things that are up the page, depending on how they play out. Market reactions, my notion or my comment around the potential impact of reducing the deficit, which would potentially would potentially reduce economic activity at some point could put some challenge to earnings growth and perhaps to stock prices. Additionally, as I talked about, as the competitive environment around the world changes and things like technology, that also could put some pressure on earnings. To the extent that the U.S. can maintain and expand its leadership in those technology places, and the opportunity for additional earnings growth will be there. But I think those are, we've seen certainly some examples in the recent environment of just things that we need to be mindful of and pay attention to in terms of potential outcomes. And then, amongst all of these things, what's the impact of non-U.S. reactions? So in the relationship of tariffs, particularly when the proposed tariffs were announced against Mexico and Canada, both of those countries responded pretty forcefully in terms of what their response would be, to U.S. tariffs. So I think, the place of the world order and conversations with others around the globe will also have some impact to market outcomes. So hopefully that was a nice solid roundup. I'd like to transition into preliminary performance for the pools through the fourth quarter. So I mentioned the yield curve did steepen in the quarter, so that did put a little bit of pressure on absolute returns for the quarter, with the exception of cash and short duration bonds. Both of those held up really pretty well. Over the course of the full calendar year for 2024, absolute returns across the board were positive. Our more bond-heavy allocations, both cash, the low-duration fixed income, which of course is all bonds, and then income and growth, which is 60%, a combination of core bonds and short-duration bonds. All in all, not bad for lower risk, lower exposed portfolios. We did see cash outperform bonds in general again for the year, in large part because the yield curve steepened. And so while short rates did come down a bit, we're still looking at short rates paying around 4%. Whereas as I mentioned, we saw the yield, even in the fourth quarter alone, the yield on the 10-year treasury went from 3.8% at the end of September to something north of 4.6% at its peak by the end of December. And so that did translate into less performance for bonds in general, but really pretty solid overall absolute results on the back of what were really pretty good absolute results in 2023. When we look at the public market long-term portfolios, essentially 75% equity, 25% bonds for each of the three of passive long-term growth, active long-term growth, and ESG long-term growth. Again, participated really pretty nicely over the course of the quarter, each down around 2% or better over the fourth quarter period, but pretty solid performance from the group, good participation from the group over the course of the year. Active long-term growth outperformed our passive counterpart by about 0.5% over the course of the year, so that's pretty solid. And a little bit weaker year for ESG long-term growth, albeit on the back of a stronger 2023. So as we saw the market rotate and evolve, we put the 2 years together, and I think by and large, pretty solid results. Diversified long-term growth, which doesn't have as much public market equity as the other pools, did on an absolute basis trail because the non-public investments, the private equity, private real assets, private debt, those tend to mark more slowly, or they tend to react more slowly quarter to quarter versus, say, the action that we see in the everyday markets in public. And so while those marks have been improving, they still haven't kept pace in the short term with the public markets, and so the near-term returns are a little bit behind. Relative performance really pretty good for the diversified long-term growth, and you can see in what was a weaker public market quarter, this is where diversified long-term growth will tend to catch up. In periods when equity markets aren't doing so well, the more diversified nature of the DLTG just allows for, more less volatile compounding of assets over time. And so we're pretty happy with that, and with 2 of the last 3 years outperforming the policy index, both in up and down markets. So with that, I will wrap my prepared remarks, and I will re-engage with Bobby to see if there are any questions in the queue, or we'll be happy to take those.
Do not see that we have any queued up. As a reminder, you can submit your questions to that Q&A bucket here.
Well, while we're waiting, I think I do think there's just I suppose some wrap-up comments and see if anyone has a question in the interim. I do think we've been living in a very strong economic environment. Economy continues to be strong. There's a lot of reasons to be confident about which direction the economy is going. That being said, there are some, we're well into a cycle environment for things like financing, and interest rate costs is a little bit different than where participants had thought it would be over the last 2 years. And so there is reason for us to be cautious and think about what's coming. The upside to the way that we build portfolios is that we build our long-term portfolios under the notion that the world is going to change and leadership is going to periodically change, and that it's very difficult to be able to see when that leadership change comes, and then to be able to position your portfolio around it. So we don't, I talk about these things under the notion of being mindful that there could be some volatility on the horizon, but that we've built our portfolios knowing that's coming, so that we can have exposure in the places that we need to have it, to take advantage of the asset classes that are continuing to perform well, like U.S. large cap, where it's the single largest position in our long-term portfolios, but also to have meaningful allocations to U.S. small, to non-U.S. and emerging markets, and including in the DLTG, to non-public investments or other alternative investments, to be able to just take advantage of those periods of time when not just a single part of the market drives overall returns. And so we want to be as educational as possible and give everyone a good sense of where we think the world is going. but also have the confidence that we've built these portfolios with the expectation that they can live through different market environments, with us not having to make a lot of short-term changes to try and chase the market around. We just think that is very difficult to do and very difficult to do well. And as a result, we only want to take advantage of those short-term changes when they feel like really fat pitches.
Excellent. And we did see some questions come through. I really do appreciate everybody submitting those here. The first one is kind of around ESG investing and asks what percentage of the portfolio is invested in ESG and if that is driven by investment policy.
So the primary ESG investments, I should say, the only dedicated ESG investments on the in the standard pool complex is the ESG pool, not a large amount of assets. We do, as part of our overall research for our managers that go into all of our client portfolios, in addition to evaluating those managers' ability to generate excess returns going forward, which is our number one criteria, we also want to understand what their sensitivities to ESG criteria are. Some investors do have a fair amount of interest in understanding, are there criteria alongside our ESG? We tend to look at it as the integration of just some additional risk factors. So when you think about, investing looking at the risks of a company, in addition to financial risks and demand for their products and the like, if it's a heavy industrial company, you should understand what the ramifications of its potential level of pollution are, or it's for a mining company, the potential for an accident that could create both a responsibility for them and cost to clean up whatever the accident might have caused, as well as potential reparations or business reputational risks that would go along with hurting demand for their product or otherwise hurting their business. So we see the integration of those kinds of notions in addition to more traditional financial concepts is just valuable in terms of understanding the entirety of the risk position. But in terms of dedicated ESG, it's the reason why the dedicated ESG pool exists for those investors with interest or desire to try and put more of a ESG spin on their investments. That's why that pool invests. The standard pools don't have a dedicated ESG exposure to them.
Excellent. Thank you so much. And another question we've had come across here. So I know that in this past year, we did have a slight reallocation to kind of increase our U.S. equity exposure. How much were we able to kind of capture some of that really strong U.S. performance and have that kind of improve our performance over this past year because of that change?
It's great. It's a great question. So just a little bit of foundational comment first, Bobby, on that. Listeners may or may not recall that our view on global stock portfolio construction is that we build first our home base, if you will, in terms of putting together our stock portfolios is around the global market cap. And so that's the breakdown on a market cap basis between U.S. stocks, developed markets, and emerging markets. Today, and I'll get the specific numbers wrong, but the directionality will be right. Probably around 64% of the global stock market capitalization is in U.S. companies today. About 10% or a little bit less is emerging markets, and the rest is in that developed non-U.S. allocation in the middle. For us, absent a very strong view, we want to be neutral to the global market cap because we ultimately want to measure the performance of our stock portfolios against that global index. We may at some point have a strong view where we might want to position differently. This most recent allocation was just if you will, it was a true up or a rebalancing to keep us in line with that global market cap. And the outcome of that was we maintained at least market exposure to the strongest performing markets over this interim period. And just to give you a sense of how these allocations have changed, I've been at Mercer for a little more than 11 years. I think when I joined, well, global market cap was around, just north of 50-50. Tim and I did a meeting together yesterday, and he related, I forget the exact number, Tim, you said from the late first decade of the 2000s, but something closer to like 43% in the US.
Yeah, when I started in '07, late '07, it was 43.57. So we were actually recommending that investors have more outside the US, which was kind of a deviation from what we saw in the institutional space at that time.
And so those alignments allow us to make sure that we're not making an implicit bet or an explicit bet against any one market if we don't have a strong view. Similar to my comment I made to wrap the closing comments around, how we make bets away from our target portfolios is we just want to make sure that we're adding value in the most consistent ways possible, and making bets away from the market or making bets away from our primary benchmarks are very difficult to do on an ad hoc basis. We want to generate much more long-term return from the implications of our big picture strategic asset allocation, as well as through the implementation approach of our managers.
Excellent. Well, thank you so much. We are kind of nearing the end of our allotted time, so I want to thank the both of you for joining us here today and sharing your insights on the market and the performance. It's always nice to be able to do these year-end reviews when we've had a market. I want to thank all of our participants for joining us. We hope you found this webinar informational and hope you're able to join us at our future webinars. I believe we're scheduled for our next one in May. Just as a reminder, we'll be posting a recording of this webinar to my FFTC as soon as possible, so please be on the lookout for that.